Multinational corporations exploit international tax treaties through a practice called treaty shopping. Here is how it works. The US has tax treaties with dozens of countries to prevent double taxation and encourage trade. These treaties often reduce withholding taxes on payments between countries. A corporation wants to move profits from the US to a tax haven like Bermuda, but there is no favorable treaty, so they route the payment through a country that has treaties with both, like the Netherlands. The US subsidiary pays royalties to a Dutch entity with minimal withholding tax due to the US-Netherlands treaty. The Dutch entity immediately forwards the payment to Bermuda with little or no tax due to Dutch law. The money traveled from the US to Bermuda but stopped in the Netherlands just long enough to exploit two treaties. This is called a conduit arrangement, and it drains billions from US tax revenue. The entities in treaty countries are often shell companies with no employees, no office, and no operations. They exist solely to facilitate treaty shopping. Recent international agreements aim to combat this through anti-abuse provisions requiring substantial business activity, but enforcement is inconsistent and loopholes remain. Companies employ armies of lawyers to structure transactions that technically comply while achieving the same tax avoidance. If you think tax treaties should facilitate legitimate trade, not profit shifting, share this message. Treaty shopping is legal but destructive, and it demonstrates how international tax competition harms all countries except tax havens.